Welcome to the second edition of the Xpansiv webinar series. My name is Rene Velasquez. I lead the global carbon team at Xpansiv Market CBL, and it is with great pleasure that I'll be moderating today's panel. I'm also happy to announce that due to popular demand, we're expanding, unintended, the series, and we shall be hosting webinars on the first Tuesday of each month. So please keep an eye out for upcoming topics and panelists. To keep topics relevant and interesting, we'll be featuring 3 streams. One, a quarterly market review. The second, a focus on market developments. And then third, a focus on technology and innovation. And throughout that, we'll be hearing from market experts, innovators, and disruptors who are helping to shape our market. Now, a few housekeeping remarks before we get underway. Given the webinar format and due to the high number of registrations, all attendees are muted by default. We do, however, encourage you to interact with us and address your questions by posting in the question section featured in the Zoom webinar panel. Now, the organisers will be monitoring your questions throughout the event, and we will, of course, do our best to address as many of them as possible. Please note that this event is actually being recorded, and the link to the recording will be made available shortly after the event. So let's begin. The first half of this year has been challenging, to say the least, for the global economy. The war in Ukraine, high inflation, slower economic growth, rising interest rates, and post-pandemic reopening pains have led to uncertainty on various fronts. There's little doubt that equities are in the worst bear market in recent memory. The S&P 500, regarded as the bellwether for global equities, has fallen by over 20% this year. Whereas global commodity markets have seen increased volatility, and many commodities, including carbon, have come off their recent highs as the market grapples with the new reality of higher interest rates, as well as the impact that they have on demand. As we look to review the first half of 2022 for the verified carbon market, we hope to gain valuable insights from our distinguished panel of market experts. So without further ado, I'd like to introduce and welcome our speakers. If you could please turn on your cameras, speakers. I'd like to introduce, firstly, Dr. Liz Minné, Global Sustainability Director from Interface. We have also Rich Gilmore with us, Chief Executive Officer from Carbon Growth Partners. We also have Adam Raphaely, from Managing Director of Trading at Mercuria Energy America, and Guy Turner, Chief Executive Officer from Trove Research. So thank you all very much for joining me today. So let's kick off today's discussion, really. In my introduction, I touched briefly on the impacts of war, inflation, and global asset prices. As you know, sort of some context, I guess, for the audience, I figured I'd also just kind of provide some additional information around how the CBL standardized contracts, the GO, the NGO, and the CGO have actually fared over the last 12 months. And we've seen, obviously, significant decreases in terms of their performance over the last 6 months. But effectively, this point really only highlights half of the picture, because as you can see here on the slide, in the 12 months preceding this current point in time, carbon markets had significant rise and gains in terms of their performance. Now, as we sort of lead into our panelists, Rich was kind enough to share with me this slide, and effectively this sort of sets you up, Rich. Oops, sorry, next slide. I'd like to turn to you first, Rich, if I can. As an asset manager of a specialized carbon fund, how would you view the effects of the past 6 months? Specifically, can you provide the audience with some insights in terms of how carbon compares to other asset classes relative to them in terms of performance? And I've got your slide up here just to kind of kick the ball off.
Sure, thanks, Rene. And I shouldn't let your initial opening remarks there go unacknowledged. I completely agree that we're operating in the verified carbon market. In my view, and the view of Carbon Growth Partners, you'll never hear anyone from our business refer to the voluntary carbon market. Emissions reductions aren't voluntary. And this market has been backed by 20 years of peer-reviewed science, of free, prior, and informed consent, of tens of thousands of project audits, hundreds and thousands of good quality projects meeting their objectives every day. And so I think getting into the habit of referring to this as the verified carbon market not only is a better reflection of what the market is, but sets it up for the necessary growth and maturity that is to come. So you're right, and with that having been said, you're right, Rene. Carbon has proved to be a very resilient asset over the past 12 months. And I think we need to get away from sort of the daily noise of looking at, as helpful as they are, the Platts mark or the Opus marks, and step back and say, how has the market performed both in absolute terms and in relative terms compared to other assets. And this is a little bit apples and oranges because you have to think about appropriate risk-adjusted returns there. But you can see the top blue line is the net returns in our first fund, the Carbon Growth Opportunities Fund. The yellow line is the KRBN fund, which we've chosen as a indicative of the sort of regulated markets because it's one of the simplest ways that investors can get access to that market. And you can see that it's outperformed all of the other asset classes that historically people look at as a sort of benchmark for performance. The other thing I guess we could add to this chart and may do in the future is a specific energy index, but it's proven to be very resilient. And so why is that? Well, we think a couple of reasons, notwithstanding a bit of a decline in the last month. The principal reason for us is, well, the returns are uncorrelated, and so that makes it an attractive asset class for more capital inflows. But more importantly, unlike, for example, perhaps, depending on your point of view on this chart, the cryptocurrency or Bitcoin chart, the carbon market is underpinned by existentially important intrinsic demand for the end use of the product. A carbon credit exists to be retired. That's its purpose. And our view is that there is stable and growing demand for carbon credits to be used as an emissions reduction tool. And if you look at the most recent emissions retirements, big carbon credit retirements for June, you can see that they're up on June 2021. And we're asked, are people going to stick to their companies going to stick to their climate commitments in this period of economic volatility, economic uncertainty, inflationary environment? Well, the evidence says yes. It's only a modest increase from 12 million tonnes in June 2021 to 13 million tonnes this June, up 30% from April and May, but it didn't go backwards. And our view is that in an economic environment this uncertain, this volatile, the fact that retirements are still increasing is a very positive sign that intrinsic demand for credits is sticky and is stable. I think it's also worth touching on the nature of the investors that are joining this market. We set out to raise our first fund in the middle of last year, June last year. We set out to raise $10 million from friends and family to bring a bit of investment grade rigor, scale and impact to this new and emerging market. We raised 50 million in about 5 weeks. So we were oversubscribed 4x. That was quickly deployed. And then Glasgow was coming up. So we decided we would go to the market and seek another $20 million to invest in the market. We raised $50 million in 5 days. I think what's interesting about that is that not only the fact that there is really significant and growing interest in this market as an asset class, but the nature of the investors who came in. The first capital raise of the first fund was very much single family offices, high net worth and ultra high net worth individuals, and some smaller scale institutional investors. The second raise of the first fund and the new raise of the second fund was much more supported by multi-family offices, wealth managers and larger institutions. And so just in that sort of 6 to 9 month window, you're really starting to see the maturity of the market evolving as you see the sophistication of more and larger players entering the market. Still got risk on investors who believe in the upside potential of this market, but very much more now sophisticated markets who understand the sort of fundamental supply and demand dynamics and the existential importance of this asset class to getting to net zero. I think one of the other things that I think is important to keep in mind is the fundamentals of those fundamentals of supply and demand. So we often talk about carbon emissions reductions and removals in percentage terms. The US is going to do 50% by 2030. Australia is going to do 43% by 2030. But I think it's more instructive to think about the market in absolutes. Getting to net zero means 50 billion tonnes of emissions reductions and removals every year forever. And we're currently generating what? 20 million tonnes a month of abatement in the carbon market. We are so wildly away from the scale that this market needs to be. I think we need to step back from the daily looking at those prices I mentioned before, daily issuances and retirements, and think about the big picture. The big picture to us says this market is still acutely and chronically undersupplied. It's existentially important, and increasingly investors are starting to back that vision. And for one more data point, Rene, because we've mentioned it earlier, if you add up all of the credits, all of the unretired credits from every registry globally, from every vintage, you can offset global emissions for 5 days. This is not a market in surplus. We talk about a growing surplus of the carbon market. Our view is that this market needs to scale and do so massively. And if we get the opportunity to talk about it later on in the Q&A, we can talk about perhaps what are the paths to getting that scale happening in the most robust way as possible. So yes, Rene, been a bit of a rocky 6 months compared to the 6 months before it. But if you step back, for us, our view is that this is still a highly compelling asset class for existing and new investors.
Great, thanks, Rich. That's fantastic context. I might just sort of change my initial game plan. I was going to go to Adam next for his opinion as from the commodities trading space. But Rich, given that you touch on a number of really interesting points, maybe we can sort of change tack, and I can go to Guy just for your input, Guy. Effectively, obviously, you're our resident data and analytics guru on the panel, and just sort of piggybacking off the points that Rich made in your most recent publication, you've shown in terms of your analysis that corporate demand for specifically forest-related carbon credits is set to vastly outstrip the available supply over the next 30 years. Maybe that's a good starting point for your sort of position and view on the market, Guy. So over to you.
Yeah, thanks. Yeah, I agree with everything that was just said. And just on that point about the long term, yes, both the planetary need for carbon reductions is unquestionable. And also when you stack up all of the commitments that companies have made across all the different types, geographies, etc., you see a huge need for carbon reductions, both mitigation. Let's not forget that the primary aim is mitigation, and the use of offsets to complement that. So those numbers, when you allocate them to the different types of projects that wouldn't be needed, and the report you mentioned that was on tropical forests, the potential demand for tropical forest reductions significantly outweighs the ability of those countries to provide them. But that is in the long term, and a lot of the net zero commitments are over 30 years, and so we will have to wait a while before some of those actually materialize and show through in terms of primary demand in the market. But if I could just sort of comment on the first half of this year as well, Rene, you mentioned that the retirements are down. Yeah, that's true, and some of the index prices have come off as well. Retirements are down about 20% in Q2 this year compared to the last quarter of last year. However, I am surprised, given what else is going on in the global economy, just how resilient this market is in the current climate. And let me give you a couple of data points. The price indices that we track, if you look at nature-based solutions, have hardly changed over the last 6 months. While some of the more technology-based credits, renewable energy, non-CO2 gases have come off, nature-based solutions, RED plus NBS, have been remarkably stable in the $12 to $14 range. That pattern is actually echoed whilst when you strip out the absolute reduction in retirements, you look at the split of retirements by project type, you've actually seen the share of nature-based solutions remain constant at about a third of all retirements over the first 6 months of this year being RED plus and nature-based solutions. There has been a significant increase in outside those nature-based projects in non-CO2 gases, so methane, ozone depleting substances, etc., up from about 18% to 30% of retirements in June. And those have been at the expense of renewable energy credits, down from about 60% of all retirements in January to about 35% now. So this is really indicative of a race to the top that is compensating for the absolute volumetric sort of fall off that we've had in retirements. Another indicator is vintages. So when we run our numbers and look at the vintage pattern of retirements over the first half of this year, in February this year, 1% of retirements were vintages 2020 or later. In June this year, 22% of retirements were of vintages of 2020 or later. So in spite of the headwinds, economic headwinds, we're seeing buyers get more focused on recency, on quality, and on nature. So, those are trends that are evidence-based that, I think should stand the test of time. And, I think are indicative of a market that's maturing and getting more knowledgeable and more sophisticated.
That's great. Thanks, guys. I appreciate that. So now, given that context, I'd like to sort of transition to Adam to get your perspective, really from a perspective of commodities trader. Is what Rich and Guy are saying in terms of the kind of the fundamentals around the demand side on the spot translating to what you're seeing on the futures? I guess, within that context, global commodities markets have been extremely volatile, certainly since February of this year when the Russian invasion of Ukraine began. I guess within the context of other commodities like gas and oil and other agricultural commodities, how are you seeing carbon faring, certainly on spot, but also primarily on the futures side?
Sure, thanks, Rene. So, maybe just kind of give a backdrop on just some numbers for perspective, more macro around the commodity complex and capital markets. Just looking at some numbers right now, WTI crude's up 29% for the year, Brent's also up 29%, gas oil up 76%, Henry Hub up 74%. You then have metals, which started the year really strongly, pulled back significantly recently, aluminum down 15%, copper down 21%. Agricultural commodities, also kind of with war in Ukraine and bottlenecks on supply, bringing some soft commodities through the Black Sea, really rallied and then pulled back significantly. Things like bean oil have pulled back kind of significantly in the last few weeks. Corn up 30% for the year. So I give these numbers because commodities have not seen this kind of volatility, supply side driven volatility, I think, in recent history. And then capital markets, to your point, S&P down 19%, NASDAQ down 27%. Maybe more appropriately, Euro stocks down 28% for the year. The DAX down almost 30%. So I give you these contexts because, the verified carbon market is a market which people have made commitments, but they're not obligated to, they're obligated in so much as they have certain targets, but the path towards those targets maybe provide some discretion. And so the fear was that people, view this commodity as a discretionary purchase. Perhaps they could delay their purchasing to allow for being able to kind of budget for the commodities and necessities, as opposed to kind of ones which, you don't take carbon and put it into an input to run a gas-fired plant or to run a refinery. So it's clearly, it's an externality that's being priced in as it should be, but absent the compliance markets, the non-compliance verified carbon market is one where, people are holding themselves to their own account in terms of, actions taken. So I think the underpinnings of the market, fundamentally are strong in so much as there's meaningful commitments from people that have large obligations. There's also, the companies that have the biggest emissions are extremely profitable at the moment. And so whereas, not to kind of think back to previous iterations of this market, but if I think back to the financial crisis of 2008, when the market was trying to get started, you had a lot of people without the means with which to meet their commitments. Whereas now, a lot of the largest emitters are very profitable and have made meaningful commitments that are not reversible as it relates to, meeting net zero or reductions in abatements, and offsets are a critical component of that as a cost competitive suite of a portfolio of internal reductions as well as external abatement opportunities. One thing I'll say in terms of how the market is trading, I think that's kudos to you, CBL, and then the exchanges, CME, and then ICE, Nodal. Everyone is trying to coalesce around providing products that provide liquidity to allow a greater degree of market participants to be able to have access to these markets. And I think that's done a really good job in doing that. One thing that I've noticed, in the past quarter or two is that there's really a manifestation of a decoupling of physical and financial markets. I think just by design, the financial markets create a basket under which physical deliverables can be delivered, but essentially it becomes to some degree a cheapest to deliver type product. And so if you have a charismatic physical product, that may very well trade at a premium, a meaningful premium, to what any exchange traded or generic product essentially is being marked at or is referenced. And so more so now than ever, we're seeing a meaningful decoupling of physical and financial products, which is not uncommon for commodity markets where you have specific specs, deliverables, grades, whereas a paper or financial contract tries to capture as much as possible. There's always going to be some basis around physical versus financial specs. And so I think that the demand for charismatic projects physically is very strong, and I think continues to be strong. And yeah, I think that the market is going through, growing pains puts kind of a negative spin on it, but I think it's more a function of just trying to kind of mature in a fashion where you're also in within the midst of a once in a generation type capital markets, commodity markets dynamic where the consumer seemingly is healthy, but the supply side bottlenecks are contributing towards inflationary pressures that maybe central banks globally don't have the tools to fully control. So I think people are grappling with what the future looks like, and I think this commodity complex, just like many others, are looking at maybe trying to find some direction in terms of how to manage risk in the short and medium term. I think the long-term picture is very compelling, and I think that we're seeing, working with customers, looking at our own ambitions, very strong underpinnings, but it's just it's a time of consolidation and market finding some maturity.
Great, fantastic intervention. Thanks, Adam. A lot to unpack there, but effectively, I'd like to kind of take some of the final points that you kind of made there, and definitely want to kind of revisit that and get inputs from the other panelists. But given obviously like what you just said around the continued strong demand, certainly from the end buyers, I figured that's a really good kind of transition opportunity here to transition to Liz to get perspective really from the lens of a corporate buyer. Liz, I guess for the benefit of the audience and folks that aren't aware, because effectively Interface is a very humble but yet well-known company, you have a very long and storied history in terms of sustainability as an enterprise. And for those that don't know, Interface's founder, Ray Anderson, famously made a business case for sustainability back in 1994, and then began really a journey in terms of embedding that and translating that in terms of your business and operational practices. And effectively, you've taken that on in terms of your entire supply chain. I've had the privilege of visiting many of your sites and had the fortune of actually working with many of your colleagues for well over a decade and learning from them. So Liz, firstly, thanks for joining us today. And then in terms of questions, I'd like to sort of propose to you a simple one. After hearing everything that Rich and Adam and Guy have mentioned around the sort of the broader context around what's happening in markets, and then kind of the translation around how that's affecting carbon in terms of the pricing, how do you see things in terms of the perspective of an offset buyer? Are you looking at this, for example, this current downturn in terms of prices as an opportunity? How are you seeing it in terms of the kind of the managing of the cash flow within the broader context? So effectively, over to you.
Thank you so much, Rene, and thanks for that introduction. Yeah, I think what's really great is that we've, as you mentioned, had a really long head start on this whole process starting in the mid-90s. So over time, we've really lowered our carbon footprint as much as we can, working with our supply chain, working internally. so that we're at a place where we can offset the rest. So we started procuring offsets back when it was the wild, wild west in 2003. The market has come a long way since then. And in 2018, we committed to make all of our flooring carbon neutral. So everything we sell is carbon neutral, and that's from cradle to grave. So raw materials, supply chain, as you mentioned, Renee, all the way till you install it in your home or your office, and then at the end when it's disposed of. And so that means that we've been trading actively in this market for a long time. And that's that portion of our portfolio, the carbon neutral floors piece, is about 85% of our entire scope 1, 2, and 3. So we have been looking at how do we make sure that we're able to keep those commitments into the future. And that means we need to keep our costs at least reasonable. And then we also need to balance our risk. There's certainly in the market different perspectives on what makes a good offset. So we're keeping an eye on that. We also, just need to make sure that we aren't going for the most expensive offsets for all of our portfolio when we, have to kind of gradually pick up there. So I would say that looking at the market as it is now, we're definitely seeing that this is an opportunity for us to look at acquiring some for our future needs. And so that we can keep our commitments going for the future, because we are committed to selling only carbon neutral floors across the board, and that's perpetually. So I think Rich touched on this on the verified carbon market versus the voluntary. It's not voluntary because we're committed to making these promises for the foreseeable future or forever. So yes, to answer your point or your question, Renee, I think that we're definitely seeing this as an opportunity, and we're looking at do we want to acquire on the spot market while prices are good? Also, what does that mean for the future market? And should we be acquiring some or contracting some of that now while the market is favorable?
Yeah, completely get that. So, no, that's fantastic. And so kind of just thank you for that, Liz. And then kind of pivoting. So Rich, it seems like you have a number of converts here in terms of the verified carbon market versus voluntary carbon market nomenclature. So kudos to you. So just in terms of, I'll open it up to the panel in terms of the broader kind of continuation of this dialogue. I think you've all provided really interesting insights in terms of where the market has been. I think it's consistent in terms of the view that yes, we've seen some downturns in terms of the carbon benchmarks, but as it's borne out in the data, and I think, Adam, you touched on this, Guy, you certainly mentioned this with regards to the indices that you're tracking around more recent vintages, and certainly on the nature-based side, as we see this transition from avoidance credits, which have historically dominated the market, towards nature-based, and then specifically long-term across to removals, that side of the market, this, as I think you labeled it, Guy, this transition towards higher quality, right? And that I think that those sides of the market have really held up. I'll open it up to any of you just to kind of provide some insights and sort of continue that thread, if you will. Adam, do you want to jump in first?
Yeah, thanks, Rene. So, I mean, one thing that I think is critical for the success in the market is we've seen, which I think is important, efforts by different agencies, groups to try and, in addition to what the registries and protocols are doing, coalesce and provide some kind of quality control stamp so that people who are looking for guidance as to what's an appropriate measure to determine what they should or shouldn't buy is being given by some third party, and they have comfort that if they're being asked internally or there's any kind of press externally, they have air cover to say, well, we're following guidance from a third party that has taken time and consensus amongst stakeholders to determine what should or shouldn't be appropriate. My fear is that, some of these efforts are not necessarily looking at having some kind of reconciliation with what's available in the market and what's scalable. And so they might give direction on something which it's almost like letting perfect be the enemy of good, in so much as, not to single out removals, but I think a lot of folks are putting a lot of efforts on removals, and removals are a critical component as part of a portfolio of nature and technology based offsets. But I think that they're not cost competitively scalable at the moment to provide the kind of volume that's needed to get the market from where we are now to where it needs to be. Now, I'm someone who thinks and advocates that they should be a critical part of it. And I think, like anything, the demand will facilitate technological innovations on the technology side to facilitate, marginal cost of reduction decreases such that it will be more cost competitive. But I think it's important to kind of look at what's available, which is quality, which is verifiable, which has consensus amongst stakeholders. Things like, reductions from, global tropical forest kind of areas, and thoughtfully managing and reducing deforestation in those areas is scalable, is cost competitive, and is a critical component that should be kind of given a lot of focus as it relates to people being able to kind of third parties give feedback as to what end use buyers should be looking to buy. One last thing I'll say is, as we look towards the future and the interplay between the verified, carbon market versus Article 6 and the implementation of NDCs and compliance with Paris, I think there's going to be some interesting interplays there. And I think you might have some interference, not in a negative fashion, but in so much as you'll have, buyers competing with kind of people who are trying to comply with NDC and Article 6 for certain tons, where the upstream tons might have corresponding adjustments in place, and not a necessity, but creates some comfort from an accounting perspective from a buyer that what they're buying is not something which can be double counted from an inventory and accounting perspective. I really think that the future of nature-based projects and scalability for the market is to move from what is primarily a project-based ton to one where you'll start to phase towards jurisdictional, whether it's subnational or national, as it relates to being able to provide scalable quality tons for the markets that will allow people that have meaningfully large ambitions to comply by utilizing kind of offsets from these jurisdictional projects in a fashion where it also addresses some of the accounting and corresponding adjustment issues that I think, in a post-2020 Paris aligned world will have to grapple with.
That's a really interesting observation. Thanks, Adam. Guy, maybe I'll turn to you just to kind of provide some additional context on that side. Obviously, given your recent publication, you touched on this very topic around not only the demand and supply side of things in relation to the net zero commitments that have been made and that you're tracking, but then specifically this kind of transition that Adam advocated with regards to project-based RED into affecting essentially the baselines and to the jurisdictional side of things. You touched in your report around the kind of the implementation or the lack thereof at this current point in time around the registry piece, etc. Do you want to just elaborate for the benefit of the audience and respond to what Adam said?
In terms of the potential risks of jurisdictional intervention, was that Adam? Was that your point?
I mean, not so much risk of intervention, more kind of like a phasing towards a project-only based offering from a supply stack perspective to one where jurisdictional projects will begin to, provide available supply to the market. And then, from a baseline and nesting perspective, the, how you phase from a market which is project-only tons to one which will have a fusion of both, and then potentially in a Paris-aligned world where many or most of the tons may come from jurisdictional because of the accounting NDC kind of issues that arise.
Yeah, it's a good point, and I have heard of a number of jurisdictional type initiatives going on in some countries, which could potentially throw large volumes into the market. And without a counterparty on the funding side or buy side, that risks, destabilizing the supply-demand balance with consequences for prices and investment, for forthcoming investment. There needs to be demand and supply need to move in lockstep, really, to make sure that the prices aren't destabilized. I am less sort of concerned about jurisdictional approaches, and I think practically nesting is a much more inter-jurisdictional approach is probably the path of least resistance and most productive. But just on that, our contacts in the market and everybody else on the call will probably have their own networks as well. But
I have having spent 20 years in these markets, I've never seen such ingenuity and effort going into looking on the ground at ways to preserve nature, improve it in nearly all developing countries, particularly the more humid tropical areas. And just coming from so many meetings with creative bankers, I would say, who are looking for degraded land to try and restore, in improving mangroves, which don't have the opportunity cost of agriculture. The potential benefits that this ingenuity at relatively modest cost to the global economy could do. In Indonesia, they're changing the rules for deforestation as a result of this. There are underpinning this sort of the market, the transactions, the exchange, and all this great stuff for in prices. There's some really good stuff going on the ground, and it's just getting going. And I'm very optimistic for what it's starting to achieve in terms of particularly on the nature side. And if that flows through into jurisdictional level approaches, that hasn't happened before, not at this scale. And I think we need to keep going and seeing some of these projects through fruition, because some of the discussions that we're party to are really exciting.
That's great. So, Guy, I think that's a perfect transition actually to my next question then for Rich. Rich, you, and I think it's you made this publicly available in terms of information for your fund. You guys have invested in blue carbon, so mangrove-based projects, and so just piggybacking off what Guy just mentioned in terms of the really innovative and really great kind of project activity that's on the ground making significant impacts. Do you want to kind of just elaborate and provide some context on that side of things in terms of, and then also respond to what Adam said around this kind of interoperability and kind of intersection between project and then jurisdictional side of things?
Yeah, I work in conservation and climate finance because I volunteered on a mangrove project 17 years ago. And it's been a long time coming. I registered the URL bluecarbon.com in 2011, and we're just starting to generate blue carbon VCUs now. And so, yeah, well, I'm very bullish on the role of mangroves and other nature-based systems, not only because they're so important from a mitigation perspective, but mangroves are that thin blue line that are so critical as an adaptation investment as well. So much of the worst effects of climate change are already baked in. There's stuff we can't do about it, and the people who are most exposed are obviously the people who have had least impact on the climate, and those are sort of coastal dwelling people in developing and least developed countries. So absolutely, we've got to protect and restore mangroves. But I would say it is absolute nonsense to say that as a proposition, prima facie, nature is better than energy. That is not true. We need to do everything everywhere all at once. And that includes a massive decarbonisation of the economy, as everyone knows. And that includes paying developing countries and least developed countries to replace their fossil fuels with renewables. And so we don't just look at the market and say, we love nature, we're passionate about it, it's why we do conservation and climate. But we don't look at the market and say, nature-based solutions are better than renewables. you've got to do more than that. You've got to get into the project level, the project type level, the geography, and then make an assessment based on all of those nuances, rather than just saying, someone told me that nature is better than, you know, renewables, so I'm going to buy nature stuff. You've got to do more work than that. But almost arguing that the counterpoint is, we're kind of getting to the starting proposition in the carbon market overall, with, you know, many of the integrity initiatives, you know, being started up. The starting proposition almost feels like the carbon market lacks integrity until proven otherwise. I don't think that's true. I think we've got more than 20 years of, as I said before, peer-reviewed evidence and science and community consultation and corporate consultation, all this stuff that's building, yes, an emerging market. But what we risk doing is undermining confidence in the market overall by focusing too much on, you know, obviously really important to focus on quality, integrity, and certainty, as we would describe it, but not to the point where it starts to undermine confidence in the market and carbon offsets as a tool. There was a question in the chat there. I noticed that, you know, don't you agree that companies have to, you know, reduce their own emissions first and then offset? And I would say, as a proposition, we can't offset I would agree with the proposition, we can't offset our way to net zero, but also say no one's trying. There is not one company in the world who's going out and saying, we're not going to have to deal with climate change because we're buying offsets.
Yeah.
They're decarbonising internally and offsetting. And I actually don't think that we can wait to do all the internal decarbonising and then offset. We've got to start reducing net emissions right now, while, exactly as Interface is doing, while we're parallel process internally decarbonising. So yes, we're strongly supportive of nature, but we wouldn't say that just at face value, nature is better than renewables. You've got to do your homework to work out what quality, integrity, and certainty means for your specific business, because I don't think there's a definition that fits everyone.
Great, thanks, Rich. And that's a perfect transition to Liz. Really, Liz, I think, you know, you touched on it in your kind of intervention earlier around the fact that Interface really began its journey in terms of the purchase of voluntary offsets back in 2003, where we didn't have standards, right? And over the last sort of 20 plus years, or 20 years, essentially 19 years since that time, we've seen the emergence of standards. We've seen that those being established. Rich touched on the kind of the infrastructure and the governance piece in terms of the development of those, and we're seeing the continuous evolution of that with regards to further third-party kind of comprehensive reviews like Adam touched on. But from just, I wanted to pick up on Rich's kind of thread around, and this is a perfect transition to kind of the Q&A, from the audience around this point around the internal decarbonisation. I think there's really no better example than Interface's journey with regards to how you guys have addressed your supply chain emissions. And do you want to kind of provide the audience just some context on that side, and then the role of offsets to kind of help to complement that journey, right?
Yeah, absolutely. Really appreciate that segue. I agree that we have to do everything everywhere all at once, because, you know, this is the crisis that we're in. But we did have, like I mentioned, sort of that head start where we really started this journey in the 90s. And so that started internally. It was a lot of, you know, what can we do at our manufacturing facilities to reduce our emissions? And then it became, oh, wow, a lot of our emissions are in our supply chain, and we need to start affecting change there, because that will really drive down our emissions across the board. So that was a lot of working with suppliers where they were, which was generally not as far ahead as we were. So going to them and teaching them about life cycle analysis and trying to measure their carbon footprint. All of those were sort of pieces to the puzzle that I think are critical for everyone, you know, in corporations. But like I said, back in 2003, we also started figuring out this whole piece of well, we're doing all this great work here, but we'd like to offer carbon neutral floors to our customers. So we started offsetting where it made sense, and then sort of grew that portfolio over time. And it was the wild, wild west then. I wasn't at Interface at the time, but I've heard that there weren't standards, the prices were really low. It was your best guess at if it was a good thing or not. So I think that standards have helped us feel better about the offsets that we're procuring and sort of mitigate that risk, like I talked about earlier. But I do respect that we can't let perfect be the enemy of the good either. So I think, as removals are starting to come online, we want to look at those too, even as standards are being developed, and sort of what is that path forward so that we're doing everything everywhere all at once.
Great. And in terms of the kind of the makeup of your portfolio, have you seen that evolve over the years in terms of, I think Adam touched on it earlier, right? In terms of there's a lot of, I guess, well-intentioned advice coming in from third parties that are kind of reviewing the market and saying, hey, we need to kind of set this North Star around this kind of transition. We hear it all the time around transition from avoidance credits to removals. And currently the only really, I guess, available option on the removal side is afforestation on the nature-based piece, and not necessarily the tech-based removal. So, given that you operate in the real world is essentially where I'm coming to, how have you seen this transition occur, right? Because I would imagine historically you've had a lot of renewables in your portfolio. What does that look like today, and what do you think it'll look like in the next 5 to 10 years?
Yeah, certainly. And we do evolve it over time. We've sort of tried to keep a diverse portfolio. So we have renewables, we've had cook stove projects, we've had forestry projects, all of those for a long time. But, we are looking at what the reflection of the market is. So what are people saying about it? So we are a little bit subject in the real world to, we don't, forestry is better versus renewables is sort of what's happening now, and then moving towards removals, or I should have said reductions from renewables. Anyway, so I think that we get that press angle upon us. So we want to make sure that we are sort of meeting the standards, but we're also looking at like the Oxford principles, for example, that have showed sort of a pathway for how do you mix your portfolio so that you move your way towards removals over time. So that's where we're looking in the real world, but we also know that currently the costs are very, very steep for those credits. So we just have to find that balance where we can get our portfolio transitioning to a better future.
That's great. So I guess on that topic, because it keeps coming up over and over in terms of the questions that we're seeing, certainly from the audience, around this kind of transition towards removals, and certainly on the tech-based side. Adam, I'll transition to you. How do you see that market evolving over time, given that, like you said, really we're in the first innings essentially, right? With methodologies effectively being devised, and then essentially R&D being invested currently into those, and so yet have not achieved scale. How do you see those technologies achieving scale, and what are the necessary, I guess, tools that the market needs to kind of bring effectively to help to see that be realized?
Sure. I mean, I think that what you're seeing is on the tech-based removals, the direct air capture is the best example I can think of. You're having a few companies that have worked on the technology, really supporting project development just as a function of being able to kind of deploy their own technology. That's where we've seen the majority of the activity to start. I think pricing is being published, in and around $100 a metric ton, and that could be the marginal cost of creation or reduction, which is a proxy for fair value. I think on the nature-based side, removals from sequestration can be a lot more cost competitive. We've seen price points anywhere from like the low to mid-teens for international NCS based to kind of the 20s and going up from there for domestic North American, from soil sequestration, other kinds of blue carbon innovative sequestration methodologies. I think what the market should do, what all markets kind of principally do in commodity markets, is you basically almost like, I think about from electricity, a dispatch model where you dispatch the cheapest first and you try and get supply to equal demand, and you kind of go up the chain, and then the marginal cost of that last remaining metric ton is going to be the most expensive. But I think you need to kind of satisfy the need for removals on everything from the cheapest first. And I think what that does is that that's an efficient market essentially. While at the same time, I think you'll have on the technology side, technological innovation that will facilitate, cost reductions for marginal creation of reductions for direct air capture and other technology based. But I think if removal is going to be a critical part of the makeup of a portfolio of an end user, I think that they should be mindful of costs and help facilitate the most efficient reduction from a removal or sequestration to be kind of procured first as a means of helping demand equal supply, let's say.
Great, that's fantastic. Rich, Guy, I'll open it up to you guys just for comments on what we've been discussing. Who would like to go first? Guy, do you want to chime in, Guy? I think Rich is pointing to you.
Well, in spite of my unbounded optimism in the first sort of round of comments, it just sort of picking up on Adam's theme of, likening this to a commodity market. That was just a comment on the chat. This market is unlike any other market, and doesn't behave like a standard commodity market. Behaves like a hybrid of a commodity market and a financial instrument. The carbon credits, once issued, have no holding cost other than the cost of money. Every other physical commodity market has a holding cost, be it an oil bunker or a warehouse with copper. Power cannot be stored cost effectively other than in pumped hydro, and has to be dispatched immediately. So that's out of the question. Gold or any other sort of fixed commodity. So the implication of that is you can issue a credit, keep it in a registry until, other than the cost of money, it'll sit there. And that inventory builds up. There's now over 680 million tons of credits sitting in inventories in the registries, issued unretired. Add to that latent volume, potentially another 500-600 million tons that are waiting to be issued from projects that have already been registered. And that is a problem in my view. Yes, they're emission reductions. They were created from validated projects. But if demand slackens off for a period of time, supply doesn't. Supply keeps pumping out. Yes, they might not be issued, but they're latent, sitting in the system. So you have it's important that demand is sort of consistent and maintained, or the market self-regulates, which encouragingly it is doing what it's doing and bringing forward the emphasis on more recent vintages and higher quality projects. There's been murmurs of vintage cutoffs, rolling vintage products like yourselves, Rene, that will sort of add an attritional sort of weight to longer dated vintages, which is a proxy for some kind of holding costs. And it's just one of the functions of this quite peculiar market, and it's just worth remembering that.
Yeah, no, I think that's an eloquent point. To counter to that, I think that, and Adam, I'd love your opinion on this. Obviously, traditional commodity markets certainly, have been stripped of a lot of their kind of attributes and effectively, homogenized to make it easy to trade. But we've seen also this kind of push now from an ESG lens to have more transparency around the supply chain and to understand the relevant inputs in terms of certainly carbon intensity of a lot of the traditional commodities, take oil and natural gas, and that's a space that on the Xpansiv side is doing. So I think there's a broader kind of context, Guy, in terms of the evolution of how information can help to shape decision making, right? But looking at the clock, we've only got sort of 5 minutes, so I figured I would kind of wrap up with these types of questions. But Guy, you made a really interesting point around this kind of supply pool of available supply, and essentially that will continue to see more and more issuances. You touched on that, Rich, earlier as well, around the kind of issuance kind of coming along like clockwork essentially over the last year certainly. But Guy, you track obviously a lot of these net zero commitments. I think you track, in terms of your analysis, over 4,000 of those commitments, and you mentioned obviously a lot of those are potentially back weighted. But when do you see that significant kind of demand coming in? Piggybacking off what Liz said, and what Adam mentioned as well, there's a marginal cost of abatement in terms of the reductions that you can achieve internally as any business. At some point in time, and I think very early on, quite frankly, given the prices of offsets, they become very, very attractive and very palatable to help to reach either the net zero or carbon neutral goals, but then also to help to set an internal price signal around the business itself. Where do you see that kind of pivot and transition point where we'll start seeing really a big inflection of the demand side?
Well, I think there's a couple of ways to look at it. One is when the primary demand, the companies who are making the commitments and retiring the credits will want to take that action. And say, for example, that happens at 2030. So a lot of interim targets are based around the end of the decade. But as Liz said, and you will see now with intermediaries, maybe Adam, yourself included, there are companies looking at their long-term obligations and saying, well, actually now might be a good time to dip into the market and acquire those credits, so to bridge that gap. So there's a big difference between when the actual retirement needs to take place by the corporate and when the trading and purchase activity needs to take place. So a great trading strategy could be to go long on the market today. And just an interesting data point, when I was modeling the European emissions trading scheme, we calculated that the market was seeing forward at least a decade, probably 9 or 10 years. When you did the maths in terms of where the fundamentals were today, the volume of credits allowances in the EU ETS and the prices that we're trading, because in theory, if there's way in excess, prices should fall to near zero. They didn't. And the reason was that the corporates in the European emissions trading scheme and trading houses were effectively hedging forward 10 years. So the intermediaries, the traders in this market, can bridge that gap between now and 2030, 2035 quite liquidly. But you need to have a hedge on the other. You need to have a hedge on the other side to do that, probably.
Definitely. And that's a really good point. I think, Rich, you said something early on in your first intervention around kind of this perceived oversupply in the market, and you kind of gave some really interesting kind of insights in terms of kind of contextualizing that within the broader kind of climate perspective. But certainly, to Guy's point, I think that's actually being borne out in the real world, insofar as the intermediaries, the financial intermediaries, the commodities traders, etc., have taken on positions, and effectively they've got some supply on their books. That supply is being effectively attrition through selling on to their clients. It's not necessarily an oversupply. It's just that they've got some inventory in stock. What's your thoughts?
That's our thesis, at least. History will determine whether we're right or not, but we think that surplus, that oversupply, is absolutely an illusion for two reasons. Total supply and usable supply aren't the same thing. The market's already decided that 2016 is the cutoff for usability as a vintage, really, because by definition, we're trying to meet the Paris Agreement. How do you meet the Paris Agreement? By retiring a credit that happened before Paris. So total supply and usable supply aren't the same. And 2050, net zero by 2050 or 2040 doesn't cut it anymore. So even if demand doesn't get taller, even if we don't see more corporate demand, it's got to compress left in the chart. That demand has got to be accelerated. Every cyclone, every flood, every snowless December in Denver is going to increase the pressure on companies and countries to do more faster. And then we're going to quickly find, in our view at least, that perceived oversupply wasn't such an oversupply after all.
Great. And I think maybe that gives you the last word, Rich. So thanks very much. I'm just conscious of time. We've just come on to 11. So look, first and foremost, I'd like to thank our panelists for really great dialogue. Thank you so much for your contributions. Really appreciate you guys joining, and I certainly think that the audience will agree with me. Also, thanks to the audience for joining us. We hope really that you've enjoyed today's discussion. And obviously then just wanted to raise, as I mentioned kind of from the outset, that we're keen to develop really a regular cadence for this webinar series, and so we'd encourage you to tune in for our next webinar, which is on August 3rd, so please stay tuned for some updates on that side. And then just to kind of round things out, that's an excuse for the shameless plug, but the environmental finance voluntary carbon market rankings are currently open. We'd encourage you to vote for CBL as the best exchange. So with that last word, thanks again for everybody for joining, and I'm going to end the webinar now. Thanks very much.